Hi, my name is Aziz. Welcome to part 1B of the course Business Management and Financial Control. Part 1B. Today, I'm going to talk about the implications of trading as a limited company, its rewards and challenges, and the penalties for non-compliance with statutory obligations. Now, let's get started. When you set up a limited company, setting up a limited company actually requires that you put in or promise to put in an amount of money in a business in order to be entitled to a share of its profit, decide how it is run, that is how the business is run, and if and when the business is wound up, you will be entitled to a share of its assets. The money that you have put in the case of a limited company, is known as your ordinary share or equity share capital. Okay? Now, having been an equity or ordinary shareholder means that you bear most of the risks and rewards associated with the business. When the business makes a profit, tax will be paid out of it, interest will be paid out of it, whatever is left will be yours. And if there's any left, if there's nothing left, then you run the risk of not being paid any money at all. But the good news is that if the business performs very well and there's plenty of and there's a lot of profit, then of course everything will be yours. And if its asset grows, then of course you stand to make other gains on associated with owning the business. If the business is not able to pay its debts, then of course you as a shareholder, ordinary shareholder, will not be required to will not be required to contribute to repaying the company's debt more than what is left unpaid on your shares. In other words, if the business gets into financial difficulty and creditors are piling pressure on the directors, you as a shareholder, what you will be required to pay will be what is still outstanding on the share that you have bought from the company. Let's say you bought £1 share from the company and you paid 80 pence on the share. Then if the company gets into trouble, you will be required to pay only 20 pence, which is what is left on your £1 share. And I will talk about other things later on. And that will be in theory. Now, to set up a limited company, you need to decide what you want to call your company. To do that, you or your consultant must search the company's register in order to ensure that the name that you have chosen for your intended company has not already been taken, that it doesn't sound or look similar to that of another company that's already in existence, that the name is not offensive, and the name that you have chosen for your company does not suggest that your business has any connection with any central or local government. Or local government department. And once you've taken care of all those things, then you can then prepare all necessary documents that will support the company that you want to set up. The documents you will prepare include the memorandum of association, Now, this document sets out, indicates or this document, memorandum of association, indicates the location of the company, its authorized share capital, that is the number of shares that is allowed to issue, and the businesses that the company is being set up to transact. It is also that, in other words, its main objects. There is also what they call the articles of association. That's another document that you need to submit in support of your application for company's registration. Now, the articles of association contains rules by which the company must be run by the directors. A standard set of rules can be adopted by any private company. That standard set of rules is contained in Table A of Companies Act 2006. You can buy that from any stationery store or any stationery department of any reputable bookshop, such as W.A. Smith or Foyles. Once you've got hold of one, all you have to do is fill the gaps with the details of your company. And you also have to submit what is called Form 10. This form will contain details of the company's first directors and its secretary. Although if you are a private limited company, you are no longer required to have a secretary. It is optional. There is also Form 12. The Form 12 has to be signed by the same person who has signed Form 10. It is a declaration that the requirements for setting up the company have been met in full. Okay? Now, after completing your forms, what do you do with them? You can send them by post or electronically to the Register of Companies, Companies House, Crown Way, Cardiff, CF 143UZ, or Register of Companies, Companies House, 37 Castle Terrace, Edinburgh, EH1 2EB. Now, if you have satisfied all requirements for company registration, you will receive a certificate of incorporation from Companies House in due course. Now, but if you believe that you do not want to do all those things yourself, you may want to contact a company formation specialist or any high street accountant to do all the work for you for a small fee ranging from £30 to £100, depending on the kind of service you want. And within 48 hours of giving them necessary details, your company will be registered. If you use the Google search engine, you will see a list of companies formation specialists, and they will give you a very good service. Right. Then after that, you need to be proactive. After you have set up your company, you need to let HMRC know. You or your agent must do that. You have to submit your notice to HMRC in the prescribed form within 3 months of starting to trade. If you don't, now you need to be aware that HMRC are Companies House share information. As soon as you set up your company with Companies House, HMRC will be notified. But if you notify HMRC yourself, then you'll be in a position to take certain steps which will be in your favor. I will explain that later on. So let me just tell you that because of the fact that the two departments now share information, it is possible to submit your statutory accounts to Companies House and corporation tax return to HMRC at the same time. So HMRC will find out as soon as you set up your company, and they will select an accounting period for you. If you don't contact them yourself to say that you have now set up a company, and the accounting period they will select for you may not necessarily agree with your own period of accounts. It may not be the same as your period of account, which will create additional work for your accountant. So let me just explain what the two means, what they mean, that accounting period and period of account. Okay. Now, what is a period of account to start with? A period of account is any length of period, any length of time. It's the length of time for which your company prepares its accounts. Usually, this will be 12 months. It may be less than 12 months if you have only just started. If it's a new company, it may be less, depending on the accounting reference date. Again, I'll talk about that a bit more. Now, accounting period, on the other hand, starts when a company starts trading or becomes liable to corporation tax. Because as soon as you start trading, you have to pay corporation tax on that, or your company's profit. Now, it also ends on the earliest of the following: 12 months from its start date, from when it starts, the end of the company's period of account, which I've already talked about, and when the company ceases to be UK resident. When a company ceases to be UK resident if it's moves its office out of the UK. I mean, I don't mean it. I mean, well, let me just say the decision making, the board of directors, who make decisions. If they shift their base to a foreign country, then of course that the company will cease to be UK resident, and that will bring its accounting period to an end. Now, if the company goes into administration or is wound up, then of course its accounting period will come to an end. So, what are the advantages of trading as a limited company? Trading as a limited company has advantages as well as pitfalls or disadvantages. The advantages are separate entity, what they call separate entity concept. You and your company are separated from each other. Your company is a separate entity. It can own assets, it can have debts, it can be sued, and it can also sue. It's a separate legal entity, not the same as its owner. So that also means that being a separate entity, if the company fails, creditors cannot go after shareholders' personal assets. They will not be able to do that. You only need, as a shareholder, or an ordinary shareholder, or equity shareholder, you only need to pay whatever is still outstanding on the shares that you have bought. If your shares are not fully paid for, then whatever is still outstanding, you only have to pay. Like I said earlier on, if after taking up shares in your company and the nominal value of the share which you have agreed to pay is say £1, and you've only paid 80 pence out of it, if the company goes into financial difficulty, then the only thing that regardless of the size of the debt, in theory, the only thing that you will need to pay will be just that 20 pence that is still outstanding. Okay? Now, another advantage of trading as a limited company is that the name of your company cannot be duplicated by anybody. That's why I said earlier on that before you set up your company, you need to do a search of the company's register, a search, just to make sure that the name has not already been taken up by somebody else. Because any company that tries to use your company's name to set up any business that tries to use your company's name to set up a business will not be registered. You will not even have to do anything about it. The company's house will not accept registration, period. Your shares, your ordinary shares, at least in theory, can be transferred to another person or to anyone who is interested in buying if you want to leave the business, at least in theory. Now, there is also the issue of tax-efficient profit extraction. What I mean by that is you can take profit as a shareholder, or maybe shareholder and director in the case of a small company. You can extract profit from your company in a way that will minimize your tax liability. Now, limited companies pay dividends to their shareholders, and what I mean by dividend is what is left of the company's profit after everything else has been paid, like tax, interest on loan, and so on, and other things. What is left is, if the company decides to give what is left to shareholders, that will be known as dividends. Okay. Now, when dividends are paid out to ordinary shareholders, there is no need to account for national insurance contribution on the payment, the same way you will account for national insurance contribution on salary or wages. Okay. Now, in the current tax year, if you collect dividends from your company, at least in the current tax year that we are in your tax return, your own personal tax returns as an individual, you have to account for dividend, but £2,000 of the dividend that you collected from your company will not be taxed. Now, this is known as dividend allowance. Okay? So, you will be able to collect dividend of £2,000 from your company in the current tax year, tax-free. You will not have to pay any income tax on that. But there are things that need to be borne in mind. Okay? When I talk about separate legal entity, when I say that your company is different from you, you are not the same as your company, etc., and you can use your company's name to borrow money or incur liability and other things. In reality, if anybody wants to lend money, could be bank or any other financial institution, if they want to lend money to your company, they will ask you to personally guarantee the company's debt before lending especially before agreeing to lend the company that money. Because especially if your company is very new and if it has no trading history, if it's only just started, if it's a new startup, even if it has a very long trading history, bank managers will want to say, look, okay, we agree that your company is separate from you and you're not the same as your company, but based on your company's trading history or your company's record, we do not believe that, we need you to guarantee this loan that we are going to give you. So they have to do that because they have investors' money to look after, and they have to ensure that investors' money is safe. Also, if shareholders or directors of limited company have traded fraudulently, if you have used your company to engage in fraudulent trading, you will be personally held responsible for any debt that arises from that fraudulent trade. Okay, you'll be personally responsible. You also cannot hide behind the fact that your company is separate from you and that you are not the same as your company, what they call limited liability or separate entity concept. You cannot hide behind that to evade employment terms, to avoid complying with employment terms or other contractual obligations. Okay, you cannot hide behind that, what they call the veil of incorporation, to do things that violate the terms of any contract that may have entered into. Yeah, here is one case. This matter happened in 1933 between Guilford Motor Company Limited versus Mr. Horn. Now, this is how the matter happened. Mr. Horn was employed by Guilford Motor Company as the managing director. In his employment contract, it was clearly stated that he must never set up any business that will rival his boss in the market. He must never set up a rival business that will undercut his boss, his employer, so to say, by charging ridiculously low prices. So what he did, later on, Mr. Horn unfortunately lost his job. He was fired. Then, after being fired, he set up a company which did precisely what his employment contract said he must not do. So the company, Guilford Motor, did not have any legal restraints upon Mr. Company himself, on the company. The company decided to take action against Mr. Horn personally, and the action succeeded. So, that is an example of how you cannot hide behind the veil of limited liability company to avoid your contractual obligations. Also, if you knowingly use your company to engage in business activities, even though the company is struggling financially and you know that the company may not be able to pay the debt and you still carry on trading, you, as directors of the company, and if you are a small company, it's likely that you are also the shareholder of the company, you'll be guilty of what they call wrongful trading. In fact, you will be deemed to have contributed to the failure of that business, and any debt that arises out of that wrongful trading will be your personal responsibility. You will pay the debt out of your pocket. Okay? So, now there are disadvantages of trading as a limited company. And one of the disadvantages is loss of privacy. As soon as you register your company with Companies House, your personal details will be publicly available through the Companies House. Anybody can search the Companies House register and they will see all your details, your name, etc., etc. And also, you will file your accounts with Companies House, which will be available to the general public, including your competitors. Though, as a private limited company, you will not have to submit your profit and loss account, but you will still have to file your balance sheet notes to the director's report. So you also have to put up with high statutory compliance costs. You have to submit accounts to Companies House. You have to file your corporation tax return. In addition to that, you must submit a confirmation statement to Companies House every year. You must do all those things. They are compulsory and they cost money. Now, also, if you decide that you want to leave the business, you want to wind up your company, it is not as simple as it is if you are a sole trader. You'll have to inform Companies House that you want to close your business. The fact that your company is about to go out of business will be made publicly known, because anybody can go to the website of Companies House and they will see what they call proposal to strike off, that you are thinking of striking up your company. Your business competitors will see it, your suppliers will see it, your creditors will see it, and any of them, if you still owe them money which you have not paid, can actually object to you winding up your company. Okay, they can object to it. So nothing is hidden. You cannot do it quietly and just disappear. Not allowed. Okay, it's because everything be out in the, for the whole world to see. Now, sole traders don't have to do that. They can just close shop and move on. Okay. Now, you also have, as a shareholder or director of a private company, there are obligations. You have obligation to file your corporation tax return and statutory accounts. You must keep proper accounting records, and you must make sure you do everything within the stipulated deadlines. You have to pay your corporation tax, and there are penalties for non-compliance with all these statutory obligations. Okay? Now, obligation to file accounting and corporation tax returns. Every limited company is obliged to do that. Okay? You can file them electronically. So, what you file electronically must include a self-assessment of the corporation tax that is payable. Your corporation tax must be accompanied by a copy of your financial accounts. So, filing your corporation tax and statutory accounts at the same time requires one tool that is called IXBRL. IXBRL, which is known as Inline Extensible Business Reporting Language. That is the tool that is used for filing both documents. It depends on the tag which computers can read. But if you are a Microsoft, if your company qualifies as a micro entity, and your business affairs are simple, you can use HMRC software to deliver both documents. Okay? The law categorizes your company as a micro entity if annual sales is less than £632,000. If the company does not employ more than 10 employees, and the total net assets of your company is not more than £316,000, then you will qualify as a macro entity, and you can use HMRC's software to submit both documents, that is your account and corporation tax return. Also, as a micro entity, you will enjoy this the benefit of not having to disclose everything to the public, your accounting details. You only have to file your balance sheet with a reduced set of information. Okay? So, though you still have to prepare full accounts for internal management purposes, you prepare your management accounts, etc., for internal use so that you can monitor the performance of your company. But what you have to make available to the general public to see will be reduced. Okay? Now, keeping accounting records. What constitutes proper accounting record depends on the nature of your business. Okay? It depends on the nature of your business. At the very basic level, accounting records must include invoices from your suppliers for goods and services, record of what you have collected from your customers, cash, what you paid out, contracts, bank statements, receipt for all expenses incurred, assets of the business, what the business owes suppliers and other people, and then if you also keep stock, a record of those your stock items. Okay. Now you can either keep those records electronically or in paper form, but they must form those records must form a reliable basis for preparing your accounts and tax return. It must be easy to extract information from the records to prepare your tax accounts and tax return. Okay, and those records must be easy to access either for inspection and other purposes. The figure that you put in your statutory account must be supported by your transaction documents, and those transaction documents they form part of your record, which I've already mentioned. As a private limited company, you must keep your record for 3 years from the date they were made, while public companies must keep them for 6 years. Public companies are those whose shares are traded on the stock exchange. Okay? But you as a private company, you cannot issue your shares to the general public. Your shares are not on the stock exchange. Although there's what they call AIM, Alternative Investment Market for small businesses. If you are not part of that as well, then of course your shares cannot be traded publicly. Okay? Now, how long must your record be kept for? Now, again, that depends on your size. Okay? Well, companies must keep accounting records until the latest of 6 years from the end of the accounting period. Yeah, it's not about size, so sorry about that. 6 years from the end of the accounting period. All companies must do that. Now, if HMRC has already initiated a compliance check, so that they are looking at your tax return, then of course you must keep your record until the end of the tax, until that compliance check has ended. And the records must be kept until that compliance check cannot be legally reopened. If HMRC runs out of time, then they will not be able to legally do anything about that if they don't finish their business within the statutory limit. So HMRC can start a compliance check into any corporation tax return within a limited period, like I've already said. But you have to be informed that a compliance check is about to commence, which will then give you, you as the directors or shareholders, or directors and shareholders in case of very, very small company, to put your house in order with regard to record keeping. Now, not having anything to show HMRC during the compliance check means that the figure that you have put on your statutory account and which you have used to prepare your tax returns have no basis whatsoever and cannot be verified. Now, that would be very serious. And failing to support your corporation tax return returns and your claims, the claim that you have made, with records that can be verified and documents which are genuine, is a very serious offense. It is also known as false accounting. False accounting. Now, there are also deadlines that you need to meet as a director of a private limited company. You must submit your accounts to Companies House within 9 months of the end of the period of accounts or accounting reference date. Okay? Within 9 months. But if you are a public company, that is those with shares traded on the stock exchange, you must submit your accounts to Companies House and HMRC within 6 months of the accounting reference date. 6 months. A corporation tax return is due for filing on the later of 12 months after the end of the period to which it relates. If the period is less than 12 months, if this period is less than 18 months in length, 30 months from the start of the period of accounts. If the company has received a notice to file a return from HMRC, then the return must be submitted within 3 months of the date of the notice. It is possible to deliver both accounts and corporation tax return electronically to HMRC at the same time using either HMRC software, if you're a small company with very simple business affairs, or IXBRL, Inline Extensible Business Reporting Language. So, like I said, accounts are due for filing within 9 months of the end of the period of accounts in the case of private companies and 6 months in the case of public companies. It means it is possible to submit account first and then corporation tax later. See, one is due within 9 months and 6 months respectively of public and private company. Private companies. One is due within 9 months in the case of private companies, and in the case of public companies, 6 months of the end of the period of account, or accounting period, our accounting reference day, sorry. The other one is due within 12 months. But it is also possible, and this is how it happens in real life, people submit both of them at the same time using either HMRC software or IXBRL. Okay? Now, you also have to pay your corporation tax. You have to pay your corporation tax. How you pay your corporation tax depends on your company's taxable profit. If your taxable profit is not more than £1.5 million, your corporation tax will be due within 9 months and 1 day after the end of your company's accounting period. But if it is more than £1.5 million, you can pay it in 4 equal installments. Okay, 4 equal installments. This arrangement actually kicked off. It's actually applicable for accounting periods ending on or after 30th of June 2002. Now, this is how you are expected to make your 4 installmental payments. Okay? First payment must be made on the 14th of July. For instance, okay, here is an example. Let me just move this thing down a little. Now, if you have an accounting, here is an example. If you have an accounting period stretching from 1st January to 2020 to 31st of December 2020, then you must make your 4 installmental payment as follows. The first payment will be due on the 14th of July 2020. Second payment will be due on the 14th of October 2020. The third payment must be made on the 14th of January 2021, and the fourth and final payment must be made on or before the 14th of April 2021. Okay? That is, if your profit is more than £1.5 million, is more than £1.5 million. Now, if you don't comply, there are consequences for non-compliance. Not filing accounting or failing to keep proper accounting records can lead to a penalty of £3,000 for each accounting period affected. £3,000 penalty for failing to keep accounting record. Late or non-filing, if you don't file your accounting record, it is a criminal offense. Okay? The penalty depends on the time involved and whether the company involved is a private or public one or public company. If you have not been more than 1 month late to pay your account and you are a private company, the penalty will be £150 initially. a fine of £150 will be due. But if you're a public company, it is £750. It will be £750. If the late period of filing, if you be late between 1 month but not more than 3 months, the penalty will rise to £375 for a private company. For a public company, it will be £1,500. If you be more than 3 months late but not up to 6 months, for a private company, the penalty will rise to £750. For a public company, it will rise to £3,000. If you be more than 6 months late, for a private company, the penalty will be £1,500. For a public company, it will be £7,500. That's a lot of money to throw away, because all these fines, after they've been paid, you will not be allowed to, you will not be given any tax relief on these fines, because fines are not acceptable as a genuine business expense for tax purposes. So they are just payment for the sake of payment, just money down the drain. That is why it has to be avoided by all means. You have to deliver your documents on time, otherwise you just waste this money. So fines are a waste of money, and that's what I keep saying to people, and I will continue to say it. Fines are a waste of money and must be avoided. Now, not filing corporation tax return, there are consequences. The initial penalty for submitting a corporation tax return late, the initial penalty is £100, not negotiable, £100. If you are over 3 months late, the penalty rises to £200. Okay? The penalty can rise to £500 and £1,000 respectively when the return is late for 2 consecutive accounting periods or not even delivered at all. They just fine you £500. If you've been late for 2 consecutive accounting periods, it will be £500. If you don't even deliver at all, and HMRC will know that you have not submitted anything, it's not a question of being late. You have just not done it at all, and you have not shown any sign that you want to do it. It will be £1,000. Now, if your corporation tax return, even after you filed it, if your corporation tax liability remains unpaid for over 6 months, there will be 10% interest. 10% interest will be added to the amount that you have not paid, which is outstanding. Okay? If the amount remains unpaid for over 12 months, the interest that will be charged on the outstanding amount will rise to 20%. Like I said earlier on, not keeping proper accounting records will lead to a penalty of £3,000 for each accounting period affected. Now, it will also expose the directors to the risk of being prosecuted. They will also be lumped with a criminal record and unlimited fine for each offense. The company's registrar could also strike off and dissolve any company that appears not to be carrying on any trade. And if a company is struck off in that manner, all the assets of the company, including cash, will become Her Majesty's property. In other words, they go to the crown. They become public property. So, now please click the subscribe button, subscribe, like and share. If you subscribe to this video, you will automatically receive all my previous videos and other videos that are coming up on a range of topics. Thank you very much for listening. Take care and bye-bye.